Welcome back from that break, and thank you for keeping it with us on UBC TV. We are still with the Capital Markets Authority. What do they do? The risks attached, and I'm still with my guest. Now, that's why I want to ask what risks are involved in this investment in capital markets, and how can an investor avoid them?
Yeah, so for the risks, what can we speak about? First thing, I think maybe what we can say is if you're unsure where to invest, because we have three types of investments, regulated products. First one we have is the unit trusts. We have shares. Then of course we have government bonds or treasury bills. Now for government bonds and treasury bills, usually this is backed by the full faith of the government. And when we talk about government and regime are different. Regime is where you have one particular president who is currently in power for a specific period of time. When that president leaves the presidential seat, then his regime ends. Now the government is separate from a regime. You might have a different president over and over and over again, but the government of Uganda still exists. So with government bonds and treasury bills, we have not seen governments defaulting in the past. The government bonds and treasury bills, even if a president were to change, you're going to still be able to get your interest, even if you invested. And I know that we have bonds, 25-year bonds, that are going to reach maturity 25 years from now. We're now in 2025. Count 25 years as 20.
Now that brings me to ask, what a bond?
Yes. Now a bond, we have two types of bonds. We have a government bond and a corporate bond. A bond is just an instrument that is issued by an entity, and that instrument has what we call an interest attached to it, what we call a coupon. So when you hold that bond, you're entitled to interest from, as a bondholder, you're entitled to interest from the issuer of that bond. So in this case, the issuers are government of Uganda and a corporate company. So
I invest in my money there?
Yes, you invest in your money and you're able to get interest every 6 months. That is for the case of a government bond. For corporate bond, the period within which you're able to get interest is determined at in the terms of the offer. And those terms are again, that's drafted at that point when the offer is being drafted by the company and the transaction advisor. Yes. So back to what I was talking about, the risks. So with government bonds and treasury bills, I would say that there's little to no risk because the bonds are backed by the full faith of the government. Now when you look at other products like unit trusts, unit trusts also, I would say almost no risk at all. Simply because all you're doing is you're putting your money away and you're getting what we call daily interest. So you'll get this daily interest, and this interest is posted on your account. You're able also to see it from your statement that is given to you every month. However, if you want to see your statement on a daily, all our unit trust managers provide those statements, a digital form of that statement. And when you go on their websites, you will be able to view how your interest is being earned. So with unit trusts, I would say, almost no risk. Now, let me come to shares. So shares, what is a share? A share is just a unit of ownership in a company. When you have maybe Paper Company Limited, I want to maybe own a share in this company, and you just cut for me a piece of that paper and you give me. That's now there, I already have a piece of the original paper, so I'm a part owner. So shares, we're talking about owning shares. When we talk about owning shares, we're talking about having part ownership in this company. So what happens when you have a share? You're able to get dividends when the company makes profit at the end of the year, and now it's time for paying the profit. You as a shareholder, you will be entitled to profit. Now the other thing which is most important about shares is that when a share price moves from one value to another value, maybe from 100 shillings to 200 shillings, you're going to get 100% of your investment. Remember, from maybe 100 to 150, you get 50% of your investment. So now that movement that we call it what we call capital growth. So whereby if a Ugandan is able to own shares in a company like MTN, in a company like Quality Chemicals, like Uganda Clays, they're able to make that profit when the share moves from one price to another. Now, I need to now come to the part of the risk. Shares move up and down. So, and this brings me to the most important part of our discussion, which is licensed investment advisors.